Yeah, so one fast comment. So everything is recorded, and we welcome questions as we go along. So anyone who's got a question as we go along, feel free to ask it. And yeah, obviously remember anything that you're asking is going to be recorded. So if you're asking, you're consenting to that. So we're going to be talking about commercial property investments, some facts, some figures. Within proper investment, I'm doing the commercial property investments with a gentleman called Duncan Knight, who has got like a lot of experience in commercial property asset management. And I'm going to immediately hand over to Duncan to introduce himself, and then I'll briefly introduce myself for people that don't know me.
Good evening. Thank you, Trevor. Thank you for the introduction. Good to be here. Good to see there's a wide sort of range of experience in the group, which is slightly daunting, but good to see. So hopefully there's going to be a lot coming out of this chat. A brief introduction from myself. It's mostly there on the screen as you can see, but started life out at Savills in 2014. Thankfully passed my ABC, which is the qualification process, in 2016, and became a qualified chartered surveyor under the RICS. And my stint at Savills was sort of mostly in asset and property management across the sort of residential, commercial, and sort of land, sort of managed estate land, but also strategic development land sectors. In and around London, the home counties, sort of Chelmsford, Essex area, and stretching into London, and then up to Peterborough as well. So that sort of north and northeast arc. And then from there, I moved into Canary Wharf, moved to a sort of boutique, polar opposite to Savills in terms of size, sort of 30-man team. It was a quasi sort of finance slash real estate company, and we were sort of basically working with lenders very closely as sort of receivers, and dealing with distressed property. So that was really interesting to work very closely to some of these lenders to see how and why they deal with real estate, and where their priorities lie. And then lastly, my sort of career of the last couple of years, I've spent working for a high net worth sort of family office in central London, as sort of head of his asset management team there. So sort of managing his residential and commercial portfolio within London and sort of the home counties as well. So sort of mostly consultancy side, but a little bit client side in the last couple of years. And then last year, I came out of that completely and launched my own real estate consultancy company as an advisor, as a chartered surveyor, but also simultaneously I launched a real estate investment company where we invest our own and other people's capital into commercial real estate in the UK.
Okay, that's great. Thank you, Duncan. Some of you already know me. I've been doing property probably only for around 6 or 7 years. Prior to that, I was working in IT, so IT project management and business development. And I decided, I wanted to get into property in order to create the ongoing income so that if I want to stop work, I can stop work and there's still the money coming in. So I started, like everyone does in the standard, like buy-to-lets, but because I wanted the cash flow, I was operating them either as serviced accommodation or HMOs, and then moved into mixed use properties. It says commercially it's primarily mixed use, where we've got, for example, the shop on the more shops on the ground floor and the flats above. And more recently, doing commercial to residential conversions. Most of these are configured as joint ventures. So there's typically the hands-off investors coming in for the return on investment, and we're looking after obviously the finance and then all the conversion work, and then renting out at the end. Mainly our aim, and the sort of thing that we're primarily promoting, is getting into property for the ongoing income. So we're not very often doing flips. we're always looking at ways to, whether this be residential or commercial, we're looking at ways to buy something, obviously sounds a bit cliched, but below market value, having some strategy to add significant value, always with the aim of holding the asset for the ongoing income, refinancing, and then to be able to basically get on to the next one. In residential, we call that BRR, buy, renovate, and refinance. And what we're going to see in a moment is we can apply similar sort of strategy on commercial properties, and we're going to see some real examples. So yeah, I'll go through this brief introduction. Duncan, if you'd like to add anything as we're going along, please feel free to. And then we're going to look, before we look at some examples of properties that we've found and that we're currently investing in or looking to invest in, Duncan's going to go through a case study of the property that he mentioned that he bought I think a year or a couple of years ago. So yeah, commercial property in the UK can give solid returns to investors with same combination of ongoing income and capital appreciation. So I'm talking about in residential, the buy, renovate, and refinance method, whereas rather than just buying a buy to let, putting the deposit in and getting the lending and forgetting about it, the BRR is really the way of getting into a project, adding sufficient value to be able to recycle the money, and rather than waiting for the capital appreciation, within 6 months, maybe getting the money out and getting on to the next one. In the case of commercial property, we can do the same, and sometimes we can actually accelerate that because we're using the principle of commercial valuation. When we're talking about like standard houses, the properties are valued based on what we call the bricks and mortar. So it's based on comparable sales values for comparable properties. Primarily, when we're talking about commercial properties, the value is not so much, it is partially based on this, not so much the value of the actual building, the bricks and mortar, how much it costs to build, but it's based on how much income that commercial property is generating. So the more, and it's based also basically on the income and what we call a commercial yield, which is the yield that we're expecting to get, an investor is expected to get in this specific area for this type of asset. So the more we can get on the income on a commercial property, then that affects its value. So the principle is, and we're going to go through that in a bit more detail, is buying commercial properties that are basically have got our income producing. So we're buying something, we're already getting the income from the property, but when we're buying it, we're seeing that there's ways to be able to, in a short time frame, increase that income. Maybe it's not fully occupied and we can increase the occupancy. Maybe there's leases coming to an end and we can renew them at market rates, at higher rates. And the faster that we can increase the income, the faster that we can get a new valuation and refinance to get money out to buy the next property. And then a little comment here, commercial property can be used as a single property investment strategy. So if maybe you're not already investing at all in property, and maybe you're thinking about investing in maybe buy-to-let or some residential property, consider also going directly into commercial property, potentially faster returns, and obviously with renters' rights bills and all this stuff coming up, less problems with commercial property. And the last comment, commercial property is suitable for SAS pension investments. So self-administered pension funds. So anyone that's got a company and existing pension can create a SAS pension, transfer pension into there and invest in commercial property. SAS can obviously invest in other things like stocks and shares. SAS can lend to companies, even people's own companies doing residential developments, but there has to be a first charge security on the development. So yeah, lots of advantages in investing in commercial property. This one, actually, I'm going to hand over to Duncan, and we're going to explain the type of commercial properties that we're targeting in order to implement this strategy of adding value, refinancing, getting money out to be able to repeat the operation.
Yeah, thank you, Trevor. And there's no hard and fast rule with this. You know, we're looking at various different opportunities for different investors at different levels. And so if there is someone who's putting their hand up and saying, you know, I just want a small retail shop, you know, a single let in you know, on the King's Road in Chelsea in London, then you know we can certainly help. Generally, our approach is that we are looking for multi-let property to give you the diversity of income and to basically spread the income or the number of sources of income you know, as many as possible, really. So we have, you know, not just 100% reliance on one tenant. We have 3 or 4 tenants who, you know, with the income present multiple opportunities within each lease to hopefully increase the income through rent reviews or lease renewals or relettings or restructuring leases. So you know, at the moment we're looking at multi-let industrial and multi-let office, and we've also looked at some retail as well over the last year. Generally speaking, and again, there's no hard and fast rule, is that we're looking at assets between 500,000 and there's an example here of just over 1 million in our presentation, but by all means we're not restricted. I think, Trevor, you know, I think it's fair to say we'd look at, you know, things as low as 200,000.
Yeah, obviously there is a bit difficult to get multi-let, or yeah, because we can't infinitely divide it up into little pieces. But yeah, exactly, yeah.
Yeah, exactly. So generally we're looking for part or fully income producing assets, which gives us a bit of security and comfort from day one that we can service any debt, and obviously the running costs of the building. And generally the strategy is to increase the income through a variety of sort of opportunities, whether that's just increasing the occupancy of the building, increasing the rents through, you know, lease reversions, i.e. rent reviews, lease renewals, and then we can also add value by spending on the building, you know, similar to residential, investing in the building externally, internally, communal areas, or taking, you know, units back and refurbishing them and reletting them at a higher rent. So there are various ways that you know we can add value, or utilizing, as I'll talk about in the next example, utilizing surplus land for, you know, additional car parking, private leasing, or sort of open storage or container storage. You know, those are other income streams which, you know, other people may not have realized or utilized or explored. That's generally the aim of the game.
Let's see what's on the next slide. Do you want to comment on that one, Duncan, or shall I take over?
Do you want to talk about the sort of the two sorts of deals that we're looking at? The sort of, you know, the sourced investments and the joint
Yes.
ventures?
Yeah, that makes sense. Yeah. So the way that we're doing things, yeah, also mentioned we're talking about typically the better deals are generally above the 500,000 mark and typically around 1 million or more up to 5 million. And in the case of we don't all have enough money if you're getting into a property that's like 1 million, typically we're talking about on commercial property. Just a second and close the door. On Commercial property, we're talking about 70% loan to value when we're buying a property. So if you've got a property that's worth around 1 million, then that's 300 for the actual purchase. We've got our stamp duty, obviously that is less than residential. We've got our legal cost valuation, sourcing fees and different things. So typically for a property that's 1 million, we need around 350 to be able to get into the deal. So either we're effectively sourcing and we're offering the ongoing management of properties for investors who want to get a single property and they've got the funds to be able to buy it themselves. And we're also doing joint ventures where we're basically setting up the company to buy the property. We're obviously finding the suitable ones, doing the ongoing management, and then a number of investors can come on board to take part in the investment and share in the ongoing income and equity. We've got a specific example of how one works later on in the slides. So yeah, Duncan explained the type of asset that we're looking for. We're not going for pure retail, and obviously we know that high streets are not always in a great situation, whereas the multi-use, multi-let are definitely promising and future-proof assets. Just as a little aside, from time to time we come across properties that maybe actually be on a high street and they're ripe for development, conversion into residential. So this is obviously a bit outside the scope of this webinar. There's going to be another one, I think, in a couple of weeks specifically on that, where we're going to go through some examples. So sometimes, as an aside, Duncan's looking at different properties and he's saying, Trevor, I've found this one. Is this any good for you for a commercial to residential conversion? And I'll run the figures and I'll say, no, this wouldn't work, or yes, this is a great deal. Let's see if someone wants that, or if we can take it on ourselves and set it up as a joint venture. So yeah, so we're deciding how we're going to go ahead with the deal. And then, yeah, we're talking about we're going to acquire the asset generally using finance. So we're increasing, obviously, we're using leverage and increasing the overall returns. Generally, the lending, we're at 70% loan to value. And at the moment, we're yeah, probably around the 7% mark on the interest rates. And then the remainder of the money is coming in from the investor. So we've got a starting yield. So the starting yield obviously is the income over the property value. And then we've got a starting return on investment, which is the actual return on the money that we've put into the deal. And then as soon as we've got the property, we're not hanging around. We're immediately deploying the strategies to increase the income so that within a relatively short amount of time, 2, 3, or maximum 4 years, we're able to refinance, get all the money out and go on to the next deal. For example, when we're doing the joint ventures, normally the aim is when the investors put the money in there, obviously there are ways of them being able to get the money out through buyback schemes. Typically it's after 5 years. But the general principle is the money goes in, we're buying the property. And when we refinance after 2, 3, or 4 years, that money that we take out within the same joint venture, we're buying a second property. So effectively, with no additional money, we're doubling the equity and not exactly doubling the income because there are additional interest costs. But we're yeah, probably multiplying by 70% the ongoing income. Yeah, so we're deploying the strategies to increase the income and the value, refinancing, and getting on to the next one. Actually, just before we go on to the case study, are there any questions or comments about what we've seen so far? I'm just looking in the chat. I think there might be some, if I can find it, some questions in there.
Yeah, I'm just sorry to interrupt you, Trevor. I was just trying to actually find your slide deck. So that was my only question. Just for some reason it's not appearing, but that's probably my fault more than anything. So I'm just I'll get to it once I can find it. But thank you anyway.
Yeah,
Sorry
right.
to
Yeah.
interrupt.
Yeah. So for some reason, I can't see if anyone's written any questions on there. I can't see the
Um,
questions. So if someone's got a question, please speak up and
yeah, I think probably
answer
it's
the question.
premature in terms of the commercial side. Um, it's really a starting point because obviously with retail being pretty poor, what you're saying is looking at properties, in my view, for the potential for multi-use, i.e., residential, commercial conversion, depending on the actual situation there. Is that the strategy that we're looking at in pure
Actually,
play
no.
retail?
What we well, yes, I'm going to say yes and no. In general, when we say multi-use, multi-use is different from what we call mixed use. So when we talk about mixed use, there we're talking about, and obviously a lot of people investing in residential are very familiar with that because your mixed use is your shop and flats above, for example, or on a
Hmm.
bigger scale, it can be a row of shops or a ground floor of retail, and then a number of floors above of apartments. So that's a mix of commercial and residential. In general, when we're talking about multi-use, we're talking about pure commercial. So there isn't a mix of commercial and residential. It's only commercial, but it's multi-use because in the block of units, we might have one unit that is occupied by, I don't know, it could be someone making cakes, for example. Another one could be a solicitor. Another one could be like a small call center. We could have a gym. So it's like
Hmm.
multi-use. There might be a cafe. There might be a shop selling some specialist
Yeah.
things, or it could be a trade counter, for example. So it's
So in essence, what we're looking at is looking at uh, commercial property that can be repurposed into these particular types of multi-use businesses to a certain degree
yeah,
within that, and that could be anywhere from second tier high street to um, retail park of some sort in that way, if I can.
that's right. Yeah.
Sure.
Generally, we're going for things that are more like, let's say, in light industrial slash office parks,
Mm.
relatively close to town centres. Sometimes they might be next to a retail park because sometimes we've got the retail park and then next to it the light industrial and office and different units.
So purpose-made units to a certain degree, where they're quite large, maybe single use, and then repurposing them for multi-use type
Yeah, or
commercial
quite
operation.
often when we buy them, they're already multi-use. Or it might be something, it might be a block which was already built with 20 units. Sometimes it might be on the ground floor. You've
Mm.
got like the shutter doors where it can be like light workshop or something. And
Yes.
then above you've got the office space. And sometimes people have got rid of the shutter doors, put nice glass windows there and operating it as some like I don't know, some like specialist kitchens or could
Yes.
be anything basically.
Well, actually, where I am right now is I think very similar to what you're saying. It's actually an ex British Rail building where there are multiple offices here and multiple businesses actually being segmented up with different offices. So this would be, I think, more or less like a classic way of what you're describing to a certain degree within the not British Rail, what they call it, the within the rail network,
Yeah,
GWR.
yeah.
Yeah, I think I understand where you're coming from.
Okay, that's fine. We'll go on now, in fact, we'll take more questions as we go along and at the end. This is a real case study, something that Duncan has done himself. So I'm going to hand over to Duncan. And the way that we're presenting on the figures here is the way that we present the figures for all the deals that we're analyzing.
Great, thank you. Yeah, just a sort of quick overview of something we bought in May last year. So just come up just over a year now, which was a multi-let office block in Middlesbrough. It's about a mile from the town centre. So it's in the heart of the nearest industrial estate. Essentially, you can probably see there's some industrial buildings in the background there. And we bought the long leasehold interest. There's about 92 years left on the lease. The freeholder is the council. And there's a peppercorning ground rent once a year. And essentially, this is arranged as 4 office blocks. In each office block, there are 6 office suites, 2 on the ground, 2 on the first, and 2 on the second floor. And we bought this essentially part income producing, so part let, but part vacant as well, which has its sort of risks and rewards, I suppose. Now this was advertised on the market by an agent who wasn't local to Middlesbrough, and slapped a very low yield on it, which basically pushed the capital value right up, and had it on the market at 900k. Now the economic sort of backdrop changed, and this deal took nearly 2 years to complete. But when the bank came along and valued it, they actually valued it at 690,000. The income and the vacancy was still the same. And we managed to get it over the line for 650 through a bit of haggling. The total annual rent at the time was 65,000 a year. And our general...
Shall I go on to the next slide, Duncan, with the figures?
Yeah, sure.
Yeah.
My approach was basically to start to reinvest some of the proceeds into some of the vacant space, to relet those, but also capitalize on, you know, the lease agreements, and the lost opportunities in terms of, you know, backdated rent reviews under the existing leases with some of the existing tenants. The leases, a typical lease there was 10 years, a break clause after 5, and rent reviews every 3 years to open market or to RPI, whichever the greater. So my approach was very simple, going along and RPIing the uplifts, and getting those agreed by the tenant, which the previous owner hadn't done. So it was sort of there ready to go. Bit of an overview in terms of the numbers, just to give some context. So advertised price 900k, and we bought it eventually 2 years later for 650, and we used a typical 70/30 LTV, and you can see there the stamp duty, conveyancing, broker valuation fees, etc. So we were all in cash wise for just over 230k. And the return profile on day one, essentially the 1st of May 2024, 65k coming in, valuation at 690, net income was 30k, and, you know, day one return on our cash is about 13%. Fast forward to today, or sort of the beginning of May, we managed to increase the income by about 35%, up to 86k. A potential valuation, you know, we fixed the mortgage for a couple of years, but if you apply, you know, the same yield as what we bought it, you know, at 690, a 10% yield would take us to about 860k if we theoretically had it valued today. Net income's increased, as you can see, and obviously the return on our cash has gone up, and we could probably, you know, theoretically pull out 210,000 in uplift if we refinance today. But our strategy is to just you know, keep increasing the income. We still have a couple of vacant units which we need to get away, but we have some rent reviews coming up this year, and so, you know, every year the income trickles up, provided we look after our tenants and they're happy. But our strategy is to aim for 100k rental income in as of sort of May 27, which should, you know, that's the point at which we could refinance and withdraw quite a large, hopefully, sum of cash, if our valuation figures are broadly correct. So anyone got any questions on that? Fire away. Otherwise, we can move on.
I was going to ask how many people can do that with their buy-to-let tenants.
Can I just ask a question? On the 1st of May 2027, sorry, is that 325,000 as a separate pullout compared to the 210, I assume?
Yeah, that's just the uplift. That's the difference between
Right.
975 and 690.
Yeah. It's
And
not a
the
separate one. It's if nothing is pulled out on the 1st of May, when we get to the 1st of May 2027, we can pull out 325. It's not an annual pull out amount.
I wish.
Yeah.
okay. So the kind of lending you have, obviously you've got a 2-year fixed interest only lending on that particular property, basically, and then you'll just go to get revalued, then pull out the money for other investments. That's pretty much what you're doing.
Correct. Yeah.
Based on the rental increases that you would initiate, and plus obviously hoping that all units are rented by that time.
Correct. Yeah. It's a longer fix. It's a 5-year fix essentially, but interest only. Yeah. At 70%.
Okay, awesome. But maybe a bit of a silly question. Is there no value in paying off the loan?
Could I mean, ideally, the bigger investors tend to operate at a lower LTV. My preference is to try and scale, but also pay down some of the debt.
Sure.
So-
Would the LTV would be increasing in each multiple here from the 1st of May to the 2027 because of the withdrawal? So would the LTV be adjusted? Because there's no, you said in your previous presentation that lending at 70 to 30, but would that not be a different, without doing the numbers, would that not change every time that you did withdraw? So the LTV would increase at that time, or would it be similar numbers, do you feel?
The LTV would reset those refinance figures on all our projections. They're based on refinancing up to an LTV of 70% on the current valuation.
Okay, so that's adjusted basically.
Yes.
An adjusted LT. It's
Yeah.
an adjusted.
Basically, it's what's the maximum we can, I'm going to say,
Yeah.
what's the maximum we can squeeze out of it? If the objective is maximum ongoing income and
Yeah.
scaling,
That's something that you guys put in as a safeguard, if I can put it that way, or the bank puts in, or both of you put in to
yeah,
actually the LTV within a workable situation. So there's equity for yourselves
that's
and the
right.
bank.
Yes. Yeah.
Right, I got you. That's why I just wanted to ask that because it wasn't there on the app. I'm sorry, I'm thinking, and funny enough, I'm actually reading it for once.
Yeah.
Now I've
As
got
a
the
complete
presentation.
as a
Now I
complete
can actually see
aside,
the numbers. Sorry, it was just I've got 2 screens and it was hiding in another screen. That's the reason why. But now I'm sort of understanding the LTV, what you're doing. Obviously, you're projecting the revenue growth, and then you're actually acting upon that, and then you're able to base the withdrawals based on future revenue increases, multiple units, and then obviously keeping within the 70 to 30% LTV. You have some money left in the deal, but not a lot, obviously.
that's correct. Yeah. What you don't see in the detail figures that obviously for the ongoing management, we are accumulating contingency for ongoing capex and things like that. So there is obviously going to be some cash accumulated, which is actually taken it when we talk about when we're looking here, net income after interest, expenses, etc. It's also after putting aside, I think we use in our model 5% of the income for ongoing capex improvements, things like that.
Thank you. Yes, that's great.
And of course, a nice aside on commercial, which probably a lot of you know, all commercial leases are, well, if it's multi-let, then it's going to be fully internal repairing. So all the internal repairs are looked after and paid for by the tenant. And in
Yes.
reality, all the external repairs are also paid for by the tenant because there's
Yeah.
ongoing service charge. Maybe Duncan, you could comment on that because maybe I've not got it exactly right.
Yeah, no, correct. Full repairing and insuring leases. So essentially, most, if not all, of the obligation for the upkeep and general repairs and maintenance to the building sits with the tenant. In this example, we have 4 communal sort of stairwells with toilets on each floor, etc. And the service charge, when we bought the building, was next to nothing. The previous owner didn't invest any money, and we've come along as sort of the bad landlord, but come along and said, look, guys, we want to improve the communal areas. We want toilets that flush. We want lights that turn on, and everyone's got to put in some service charge money into the pot, and we'll start to play catch up on all these repairs. And gradually we're just elevating the standard and the condition of the communal areas, which obviously helps your capital value when you come to a revaluation.
Yeah, a bit like for those doing residential, if you've got an HMO that's in a poor condition, you probably got tenants in there that are not paying or not looking after it. And as you increase the standard of the property, you're attracting better tenants and charging more money. So a lot of the principles that we see in residential, because I'm probably talking to a lot of residential landlords or developers, a lot of the principles that we apply there apply exactly in commercial, but on different scales and in different ways. In some ways, it's quite a bit easier.
Can I ask? Is there a question I can ask about the deposit?
Yeah.
So obviously the deposit there of about 195,000, was that with investor money or was that self-funded? And the second question I have is, if it was investor money, so I'm trying to understand, where would they be benefiting from in this deal, in terms of, and the timescale that they would do, just sort of as an investor.
I'm going to answer that question on the next slide, because
thank you, Russ. I already got there. Right.
Yeah. So I'm going to go on to the next one.
Yeah.
And,
so I'm thinking again, it's a dangerous thing, unfortunately.
That's fine. Yeah. Before I go on to the next one, I'm going to comment on the type of ROIs that we're getting here are not, I mean, they're really good, but they're not exceptional in the case that it's impossible to reproduce these. We are able to find, and we are finding properties. I mean, it's on the high end of the best things that we can get, but we are able to achieve these, and quite a few of the deals that we're sourcing, or the next one they're going to mention, which is a joint venture, is getting similar figures to those. So this one, so we've got a few opportunities we're just going to talk about. So this one is, I'm going to let Duncan explain very briefly what the property is, as in, I mean, we've both been to see it, and then I'm going to talk about the figures.
Yeah, great. Sorry, just to answer your question, Vincolo. It was a combination of personal money and some family money as well.
Thank you.
Sorry. Just before I forget. So here we have a regional office space based on a business park in Wakefield, just next to Leeds. Very good location. The whole park is owned by a fund, and they are selling off one of these buildings. And as far as I understand, the reason is to recycle some of the capital back into investing in elsewhere on the park. But a great building. Been to view it. Trevor's seen it. It's 2 floors of open plan office space, and the ground floor is completely let to a fairly strong covenant, and they are paying about 95 grand a year. And the first floor has been refurbished by the landlord. It looks pretty good, and it's currently on the market, but vacant, so ready to be re-let. So great location, great positioning. It presents really well. It's a very smart building. It's relatively new in terms of construction, plenty of parking, and it's sort of on a self-contained sort of plot, really. So it's quite, it has all the hallmarks of of being well utilized. So the strategy here essentially is to purchase. I mean, it's been priced very well. It's almost like a mispricing sometimes that you see occasionally, where they have basically priced it on a yield on the ground floor and haven't put a price at all on the first floor. So 95k coming in rent, and I think they had on the market at 900, and we've got a price agreed at 870. So I'll let Trevor hand over.
Yeah, so I'll go on to the figures. So the way that this works, the same thing. So we've got the agreed price on it, 70% loan to value for the finance.
I'm here for the meeting.
Sorry, was there a question there? Okay, I'm going to yeah, carry on.
Interruption.
Yeah. So as usual, we've got
Go ahead.
Yeah, okay, right, yeah. So 70% loan to value. So the deposit is well, we can see the figures 261.32 for the stamp duty. So this one we're doing is a joint venture. So without going into all the details, we can talk to people, anyone that's interested in this, in a different call, because this is mainly to explain the principle of how things work. Obviously, we've got the setup for the SPV, so the limited company that is set up for buying that property, obviously with the modified articles of association, shareholders agreement and everything legally drawn up. Then we've got conveyancing arrangement, acquisition fee. In this case also, we've got contingency. One of the main reasons for this contingency is the whole of the first floor is open plan, as Duncan indicated. We're not sure that we're going to get a tenant that will want the whole of the first floor, but we're sure that there's plenty of tenants in the area that will take smaller spaces. So we put aside some money to be able to create smaller office spaces on that first floor in order to get it rented out really fast. So the amount of money that we need to be able to get into the deal is this 370,000. I'll explain in a moment how this works for investors. As regards the valuation, so based on the local yields, we're looking actually a current valuation of 950,000 with the purchase price of 87, but that is based on the current income. Once we have the first floor fully let, we're basically doubling the income. And when that income is stabilized, we can go back to the bank, we can go back to the lender and get basically a double valuation on the property. And that could be within less than 2 years. So instead of being worth 950, it's going to be worth 1.8 million. So there, obviously, we've got the higher income, and we're able at that point to be able to get out 645,000 to be able to reinvest in another property, or to be used as a deposit for investing in another property. And the terms of this joint venture is that investors who put money in, it's with although I mentioned before, there is every 5 years a possibility of buyback, but it's with the aim as when we're able to refinance, we use that money to buy another property. The way that we give the overall figures, obviously we've got the potential net income. So that's a net income once we've obviously got the income, we paid the mortgage and all the different fees. Then we've got, obviously we're paying corporation tax on that profit, and we're talking about the distributable income. So that income is distributed between the shareholders. There are founder shareholders who are Duncan and myself in this project, and we have 20% of the shareholding. The investor shareholders come in with 80% of the shareholding. However, as regards the sharing of the income, the first 8% of distributable income, so after tax, goes only to the investor shareholders. So there where it says investors tranche 1, everything goes to the investor shareholders. For what is above the 8%, then part of that goes to the founder shareholders, Duncan, myself, and then the remainder goes to the investor shareholders. So the end of that calculation basically is investors who come on board. The ROI, immediate ROI, is around 7.9% based on the current income. And then here is the projected ROI, which is based on getting the first floor let. So that's the potential ROI. And obviously, investors who come on board also have a share in the ownership of the property. So there's also the increase in the equity. And we can see the projection. This projection on ROI is only for this single property, but on the assumption that when we can refinance after 2 years and we buy a second property, then obviously the equity is going to be virtually doubled. The ROI is not going to be doubled because obviously we've got the lending costs on the second property, but approximately it's likely to go from 17% to something like 30%. And so that's how it works on the joint venture. Obviously, if it's a sourced deal, the figures are fairly similar, maybe potentially a little bit higher because there isn't the founder's share for Duncan and myself, but we're talking about similar figures. On the last 2 slides, we've got a couple of examples of deals that we have ready that we're proposing basically to investors who want to buy the complete deal. So we call these sourced and managed deals.
Can I ask a question?
Yeah, go ahead.
Sorry, I'm just trying to get through the numbers in terms of the pretty straightforward in terms of corporation tax. The distributable income obviously is the income, and then there's the 8% threshold. Sorry, can you just explain the 8% threshold? Is that the threshold that is like a tripwire, so that this is where investors start to get paid? Or
no, it's the opposite. So obviously when we set up these deals,
yeah,
Duncan and myself, we're not putting to be blunt much money into it.
of course.
We found but we still have an equity share, so we have a 20% equity share. However, what the deal is that until we've generated more than 8% return on investment for the investors, we're not taking any money.
Right.
So let's say you put 100,000 into this deal.
Yeah.
In the first year, until we've got the first floor occupied.
Yes.
The distributable income is 29,000.
Yes.
So that wouldn't give you quite 8% return. Is 7.9%, and all of that would be going to you as an investor partner.
I got you.
However, when we get to the next year,
yes,
we've got tranche 1, which is this amount. So that's the 8%.
yes.
So the first 8% goes only to the investors who put the funds in.
Yes.
And then above that 8%, there's 60% of it goes to the investor partners, and 40% of it goes to Duncan and myself. Hence, we've got the tranche 1 and the tranche 2.
Yeah.
That's a total amount so in reality here we see we've got 89,000 of distributable income. 65 goes to the investors, and the remainder obviously is the founder shareholders, Duncan and myself. But for what actually goes to the investors, that represents 17.7% on the money that they put into the deal.
Okay. All right. So so yes, there's a minimum there of 8% before that goes forward. And so is there just a question in terms of the first floor that needs to be let to a certain degree? Has the landlord or the seller, did they ever confirm that it was ever let before in terms of any revenue that and in the past?
Yeah, it was actually let by the same company, and they downsized. So they were renting the complete building, both floors.
Right.
And it was probably something like a year or 2 ago. It's a massive company. They've got offices throughout the UK. It's a food distribution company. when I was there last week, I was chatting to some
Yeah.
of the IT guys. I said, "Are you okay for your
Yeah.
yeah, for your cyber security?" And obviously, they're very, very aware
Twitchy.
of that.
Twitchy is the right word, isn't it, nowadays?
That's right. Yeah. So yeah. Anyway, and they were
Mm,
so it's only, I think it's become vacant something like around
yeah.
a year ago,
Okay.
and the current owners have sort of completely revamped it. But in
Okay.
reality, because they're selling, they have put it on the market, but not with any
Well, so
effort or wish to sort of really want
to
to let it.
to ask another question, what would be the metrics of carving up that office on the floor and kind of rentals that you're looking for? And is that something that would you'd be advised to, or would you have a sort of an idea of, or would the like a commercial agent give you that kind of view of
Yeah,
what
I mean
they
that is
do?
Duncan's speciality,
Ah,
and
okay.
which I'm going to let him answer that.
Yeah.
But
Thank you
he
for
would
that.
also, obviously, I know that Duncan would also be speaking with the
Mhm.
local agents as well to get their feedback. But yeah, Duncan, if you'd like to answer that question.
That's awesome.
Yeah, so the idea with this space, and a lot of this hinges on the releasing strategy, is subdividing the space into 2 or 3 units. The
Mm.
sweet spot is, between 2 and 4,000 square feet, and the total here is just over 8,000 square feet. Um, and rents are slightly higher at the moment. The tenants on the ground floor are paying about £9 a square foot. Smaller spaces attract a slight premium, and at the moment, the evidence suggests that they are basically letting at around 11 or 12,000 pounds a
Oh,
square
really?
foot.
So really,
Yeah.
it is more profitable to get smaller offices to a certain degree, which then increases your revenue and also improves the redundancy in terms of your revenue streams too.
Yeah, and diversifies the income, right? So
Mm.
you haven't got two, you've got maybe four or
Yeah,
five income sources. A little bit heavier on the asset and property management, but providing you design the space correctly, and we'd engage with a local, office fit out company,
yeah,
in conjunction with another local agent, just to basically ensure that we are all talking on the same page and we're all looking at the same numbers and we're utilizing the space very well. But they've got their own kitchen breakout area, their own toilets up there, and it's this huge open plan, refurbished office space.
yeah.
So it's partitioning, it's rewiring some of the cabling and the utilities, putting in some kitchenettes, etc. But it's not light touch, but it's not,
Yeah.
it's not full scale redevelopment.
Yeah.
I see.
Before we
So
take
really
any, sorry,
doing.
Vincent,
Mm.
before we take any more questions, because we're getting close to 8 o'clock, we're going
Oh,
to have
Jesus.
time for more questions and we can extend this. I'm just going to run fast past the other two slides, so that people who are fed up and want to go home
Yeah.
can do so. They'll have seen everything, and then we can take what yeah, 10-15 minutes for any other questions.
Yeah, Trevor, I suppose we could just remind everyone that if they are interested in a particular deal, contact yourself directly, and we can have a
Yes.
very, open, one-on-one conversation online with them, after the call.
That's right, yeah. And if anyone would like to leave their email or phone number and name, I actually see that I got access to the chat now. I can see and the chat will remain afterwards. So if anyone would like to put their name, phone number, email, we can have a chat, or yeah, send and if anyone wants a copy of the presentation, leave a message on here with email and we'll send you the presentation. We've got a document as well that goes into a little bit more details as well. So these are a couple of opportunities, because generally we're doing one joint venture sort of live at a particular point in time. And then at the same time, we've got a few like ad hoc um, deals that we've got available. And then the other thing is if someone says we're looking for this specific type of property, then as long as it's something that we're able to find, we can find and potentially manage it. Sometimes the management, depending on where it is, might be in conjunction with a local agent, but still under Duncan's oversight. So I'm going to let Duncan explain in 1 minute for each of these properties.
Yeah, so essentially here we've got an opportunity to buy a site which contains 22 offices, as you can see there in the photographs, just outside Durham. The purchase price here is 1.1 million for the whole thing. Some of these have already been sold off on a long leasehold basis, 120-year long leases. But most of them are available. The freehold interests are available, and quite a few of them are basically already been let out. So there's some income there from day one. There's also an opportunity here to sell off some of these other freehold office blocks on a long leasehold basis to sort of, as an arbitrage to profiteer from the inbound price and the exit price, but also there's an opportunity to hold this as an asset and improve the occupancy, but also improve the income. So you can see the rough numbers there. Trevor
You can see the exact numbers here. Well,
Yeah.
the exact numbers and obviously the
Trevor.
projections. Yeah, so here again, just in 30 seconds, the same stack for the money required, and the same thing on the potential valuation going forward. And this one, we're looking at all money out after 3 years. And then I go on to the last one that we've got here, which is a little bit different. But yeah, go ahead, Duncan.
So I'm just reading the chat. Brad,
Yeah.
there's quite a few questions in there which we need to come back to. Great opportunity to buy this property in Bradford, which is a multi-let office block. It's a very sort of not vanilla, but it's a safer deal in the fact that it's fully let. It's a slightly lower yielding opportunity, but it's a great starter asset for someone who's just coming in. It's a listed property, exempt from business rates. It's fully leased, and there are about 11 different tenants there. So there are plenty of opportunities to increase the rent throughout the next couple of years. And indeed, the person we're buying it off has been managing it for the last 25 years, so knows everything about the building and is very happy to help us in the transition period as well in terms of the management. But here are the numbers.
Yeah, and this one is more like 5 years for the all the money out. But it's a question of also what not really, none of these have got any real big risk. But some of them, like this one, it's more like buying a fully tenanted HMO in perfect condition, and we can do a bit of improvements primarily through increasing the rents as and when leases come up for renewal. But there's not any like massive big steps to do anything, and with 11 different tenants in there, very low risk.
Yeah, and it's low risk, but it's not a bad return on your investment over the first 5 years, really. Comparatively speaking, it's quite realistic, but also quite good if you look at other asset classes.
Yeah. Right, so the next slide is questions. If anyone wants to know my number, WhatsApp is probably the best way of getting hold of me. It's not very often that I'm able to actually answer the phone, but please, yeah, send messages. Take a copy or note that down, and we're open for questions.
I think there are some questions in the chat.
Just a moment. Yeah, I see a question. Please send the slide so we can do all that. Just having a look.
Hannah's asked, how are your lenders fared on JV and such projections?
You want me to answer that, Duncan? Yeah. Generally, we're I'm going to say generally fared quite well, in the sense that lenders generally need well, obviously 2 or 3 things. They need to understand exactly how the structure of the companies are set up. So when it's the joint ventures, obviously we've got like the standard templates, legally drawn up templates that we use. And generally we're sharing all this information not at the end, but when we're actually with the brokers or directly with the banks. So everything is shared up front. And yeah, generally there's no big issue with this. If you've got maybe some specific question, maybe I haven't answered the question, please speak up and ask it.
Yeah, we also work with brokers, don't we, Trevor?
Yeah.
Who are very good at structuring these deals, but also targeting lenders who are, more au fait with JVs than others, let's say.
And one thing that lenders always are looking for is the experience and the people behind it. And so obviously, Duncan and myself, we're bringing that experience so that in reality, the investors don't have to have it. So on the sourced and managed deals, that sometimes it might be a little bit more tricky because someone who wants to buy a commercial property, they've got no experience. But at the same time, if obviously there's agreement that we would manage the property on behalf of the investor, that can help get it over the line with the brokers or with the banks. Are there any other questions? I'm just looking through. There's one here. What's the cost to get to this rental figure? And are you proposing 3 years to take all money out? I think on the yeah, on that first deal it was 3 years to be able to get all money out. But the projections are always based on updated income and value based on the existing yield, so the commercial yield, and refinancing at 70% loan to value. So that's how we get the figures. And whatever deal we're proposing, we're always using the same format. So it's easy like to compare from one to another.
I noticed obviously on one of the deals that the costings for the legals, the JV deal, was about £9,600 as such. Is there a particular reason why it was that sort of level of cost? Is that because of the negotiations between the investors and their solicitors and yourselves? Is that the reason why that was
No,
around?
it's generally the costs for setting up and also the generally it might sound strange. There isn't generally negotiation as such. It depends. If it's like a joint venture, like the one that we're showing here, where there's likely to typically the minimum investment is £50,000. And we can only take people who can justify a sophisticated investor, all the standard stuff, high net worth or yeah, that sort of thing. Generally, when it's like a number of investors, like 4 or 5, we have the legally drafted shareholders agreement set up. Everything obviously properly registered at Company's House. And it's a question for the investor partners either to say, yeah, I'm happy with that, I want to go ahead, or I don't like it, sort of thing. There's not generally negotiation in the sense that we can't negotiate with like 4 or 5 different people. However, when it's maybe one investor who comes in as a joint venture partner, there we've got like we do when we do when I'm doing like the commercial to residential conversions. If it's like 5 or 6 investors, it's sort of here's a deal. This is how it's set up. Do you want to come on? Obviously, if someone's solicitor finds something in the agreement that maybe isn't being completely watertight, and that makes sense, then we'll say, yeah, that's fine. We'll adjust that, and it's adjusted for everyone. But in the case of like one investor, then obviously there we've got the possibility of yeah, discussing the terms and also integrating the investor in like a decision making as to once we're able to refinance, what sort of deal do you want to go for next, or do we want to take that money out and return it to the investor?
Yeah, going back to one of my questions about the investor and because obviously you're providing them a investment deal. The terms are already set within the investment deal. That's basically what you're saying.
Basically, yes.
And that is based on day one results as well as the projection going down the road, which obviously has no guarantee. So obviously it's an
That's
investment.
correct.
There is some risk here. When it comes to the share agreement, because you mentioned earlier, and again, I was listening, you said you had about 20%, depending on the number of investors. No one individual has a controlling interest in that company. Is that set up like that for that reason? So it becomes a collaboration or is that already set up in the investment deal that you're running the company to a certain degree or managing that?
So generally, it is effectively Duncan and myself who are managing it.
Yes.
And in fact, the founder partners, Duncan and myself, we can appoint up to 2 directors.
Yes.
The investor shareholders can appoint up to 1 director, so
Yes.
they can have someone sitting on the board. In
Yes.
practice, generally on the joint ventures, they don't bother,
No, they don't. No.
but it's there as a protection.
Okay.
And because the structure of the investment and what we're going to be doing is already set up in advance, there generally aren't any major decisions. And the key things obviously is, even though Duncan and myself would have a higher level of control, we're not allowed to do anything which changes the rights of investor shareholders.
Completely understand.
Without obviously that's a I think it's a 75% majority if we wanted to change something within the shareholders agreement.
Yes.
I mean, that's not sometimes we might come across something completely unplanned and we think, look, we need to change the direction. It's something that's not planned, in which case that goes to an open vote based on the number of shares that are held.
Yeah, that would be on a board
That's
meeting.
right, yeah.
So that could be voted upon in terms of that change if it was needed it to be.
Yeah.
Okay. Excellent. Thank you.
Yeah, and so that also explains partly the cost, because everything theoretically has been taken care of within the shareholders agreement.
Yeah, it's pretty critical. I can see now. Very critical. Very critical. Thank you. That's very clear. Thank you.
Trevor and Duncan, from my perspective, out of the hundreds sessions I've attended, I really enjoyed your sessions because you guys were like to the bone. Okay.
Yeah.
Even giving the financial figures. And seriously, for a person like me, when I look at this, you haven't used any complicated formulas or high funder stuff. You guys have literally stuck to the basics and got success. I really admire you guys and more than happy to kind of collaborate with you. And I'm excited that you guys are London based. I'm London based.
Yeah.
But I'll tell you, I do sit on these sessions just for information gathering. It's not whether you know how much you know and how far you know and what you know. But I'll tell you, I've literally picked the needle from the stack of needles, if you understand what I'm saying.
Yes.
I've not got one presenter, not one in more than 100 sessions that I've attended, that have been as neat as you guys. Keep it up, man.
Thank
We
you.
need people like you.
Don't say too much because we'll get too big. But yeah, thank you.
Thank you very much. That's very kind. Thank you.
Yes. So let's take one last question, and then we'll wrap it up for today if there is any last question.
Yeah, just one question. I mean, how if there's if somebody wishes to get involved in this sort of area of investment or running or getting into this, where do we go from here to a certain degree? I think that's probably a better question.
Yeah. Basically to send me a message or a direct message, and then we'll depending on we'll either organize a follow-up call or for those that are based in London, happy to meet up.
Whereabouts in London are you, Trevor?
I'm close to the centre, close to St James Park station, so like the Victoria area.
Oh, fantastic, fantastic.
I'm in Putneys, but yeah, very happy to meet wherever in London, whatever works.
Yeah, and obviously here what we're showing are the main figures. We've got behind here the Excel files that have got 4 times the information, and we're obviously always sharing those with people that are interested to understand more. Generally there, when we get to that level, we're asking for NDAs to be put in place.
Of course.
Okay, well, thank you very much for your time and for listening. And again, anyone that would like the to get in contact with us, I'll just put my number again at the end. Please feel free to send me a message and put a message on the chat, or send me a message and we'll get the copy of the slides and the document out to you.
Great. Thank you very much, everyone. Great to
Yeah.
meet you all.
And
you.
also there
Thank
is
you,
a
guys.
recording of this, and everyone will have access to the recording.
Thank you. It's been fantastic. Thank you.
Thank
Right.
you.
Yeah,
Thank
thank
you.
you all. Yeah.
Thank you.
Thanks. Bye.
Bye.